Hello and welcome to part 3 of the Essentials to Day Trading. And today we're going to talk about assessing the opportunities inside the daily range. So our aim is to capitalize on the movement inside the daily range, and what we're looking for is we're looking to capture a major portion of the daily candle, which is our goal here. We did not expose ourselves to risk every day. Our goal is not everyday trading, which is a huge mistake a lot of you guys actually make in trading, where you go into the marketplace and you're looking to trade every single day, which is what I see online everywhere. No, there's no protocols, there's no assessment of risk, or there's no evaluation of risk. It's just straight up go into price every single day looking for executions and just trade whatever you see. That's not how you go into price to trade. That's not the professional way of trading. Right, the professional way of trading is anticipating daily conditions that puts the odd in your favor and then executing in those conditions. Now with the or inside the daily range, we generally have two windows of opportunity. Now you already know the classic major kill zones. So a kill zone essentially is the window of time inside of the day where you can find setups due to the increased volatility during that time of the day. Now we generally have London session, and then we have New York session, and then we have one more, which is actually London close. But because we have three windows of opportunity in price, that does not mean you're actually going to get three windows of opportunity to look for a day trade in the direction of the daily range. Usually it's going to be one or two. So classically, if we see expansion or if we see a low form your London session and starts to expand in direction of the daily range, and then your continues the expansion, which is another opportunity for a continuation trade. The eye of the day usually will be capped off during London close, and that's not going to offer a setup in direction of daily order flow. Only during extreme situations where the daily range is very, very massive and the market is making a very strong rally either towards an higher time frame objective or the market is making a long-term reversal in price. That's where you get a day where both New York session and London session and also London close all trades in the same direction. But generally, which is around 80 to 90% of the time, if both London and New York trades in the same direction, then London close would cap off the higher low of the day. Or if New York reverses against London session, then London close would still classically cap off the low of the day. So, number 4, trading in the direction of the anticipated daily range is our goal, and capturing 60% to 70% of the daily range is what we aim for. Now, the logic here is that if I go out to a blank chart, I've already utilized this description in terms of how to anticipate daily delivery. We're going to talk about this even more with the slide, or not the slide, but with the bulletin. But with the daily range, what we're looking for is we're looking to capture the portion of that daily expansion. Now, if you have a weekly expansion bias to the upside, then you're going to see more expansion on the daily candle higher versus lower. And what you're looking for is you're looking for days where you can capture a buy in direction of that weekly expansion. Now, this is what a classic daily candle will look like. You have your opening price, and then you have your run lower, and then price starts to trade away from there. And this run lower usually is a run to a discount. So this is a usually is going to be some kind of buy time from discount. So you have your opening price here, and then the market starts to run lower into that high time from discount, and then starts to trade above. And what's going on here is from the open price it run lower in a predisposed bullish order flow. So we're going to label this here as predisposed for bullishness. So in a order flow on the daily time frame, which is principles for bullishness, this is classic price delivery where the market runs lower, trades down to the time frame discount or a discount. It could be a lower time frame discount also, but most of the time you're going to see the explosive moves in the direction of daily order flow from higher time frame discount, which could be a daily or weekly level, or sometimes even a monthly level. And then as the market starts to get back into the opening price, the algo kicks into what we call the profit release phase. Now, what actually happens here is that the initial run lower to the higher time frame discount is what we consider as smart money accumulation. What does that mean? In a bullish daily candle, smart money will accumulate longs below the opening price. In a bearish daily candle, smart money will accumulate shorts above the opening price. Now, what time is the opening price? We're actually going to get into the time windows for each session. But what time actually is the opening price? It is 12 a.m. midnight New York. And I know classically, what you think the opening price for each day is midnight GMT time zone, which is 12 a.m. GMT, which delineates a new trading day. But we're not talking about the new trading day. We're talking about 3-day open. Okay, so with 3-day open, we're looking at 12 a.m. midnight New York, which is what starts the real cycle for price delivery every single day. The run lower below that midnight price or 12 a.m. candle or 12 a.m. opening price, that's smart money accumulation. And then as price starts to expand during London session, it'll expand around 50% of the range. Sometimes it could be, generally it's around 30 to 60% of the range will be done during London session. And then going into London lunch, and London lunch is a time period between London Kilzone and New York Kilzone. That's where the market will go into the first stage of squaring or profit taking or distribution for a predisposed bullish order flow in a daily bullish candle. And then during New York session, the market will run lower again into lower time frame discount inside the range between London session to whatever high forms prior to the start of New York session. The market will run into a discount and then continue the cycle higher for some kind of premium. Okay, usually to lower time frame premium. If you went through the short-term trading module, we talked about how when you're aiming for a liquidity, you always want to aim for liquidity on a time frame which is lower than the time frame that your idea originates from. So if our idea originates from the higher time frame here, which is daily discount or weekly discount, that we're looking for like a 1-hour premium array or a 15-minute premium array to target intraday setups. But the goal is, again, if we're anticipating a daily bullish expansion, then the low resistance liquidity run would always be in the direction of that daily candle, right? So we're looking for a lower time frame liquidity run from the previous day or the last 20 days. If that is a range, that's also something you can utilize in your, or that's also something that has to be utilized in your profile. And usually heading into London close or New York close, London close, we start to see some profit taking. So London close comes immediately after New York session. New York session is a 3-hour window which starts between 7 a.m. and ends around 10 a.m. Eastern. And then London close starts around 10 a.m. Eastern going into noon. And that's where we usually see profit taking. But sometimes we can see profit taking towards the last 1 hour of New York session. And then the market is trading at a lower time frame premium where distribution from the initial accumulation during London session occurred, and there will be some profit taking there, and that's where you have your high for the day. And then the market goes into consolidation into the end of New York close, and this will be the profit release phase here. So let's actually build this profit release phase. Now let's actually put this to the right. And then this small little wick there is going to be the distribution cycle for the daily range. So this is your classic daily bullish candle. You have your opening price, you have your run lower into a discount, which is where smart money will accumulate longs. And then as the market starts to trade away from that discount, the algo starts the profit expansion cycle, where you tend to see a lot of times inefficiencies in price. Right, the market starts to create inefficiencies and then runs for a lower time frame premium, where there's gonna be offset distribution. So there's offsetting of long positions down here to, or sorry, there's offsetting of long positions up here from buyers down here to willing buyers up here, or willing to do transactions up here. So that's how the daily cycle looks like. So we can actually see this in effect from yesterday's price action on euro, and we're going to go and look at euro. And if you look at the price action in euro, so let's actually use a different feed. So we're going to use a different feed for this, and this is the price action in euro from yesterday, right? And you can see here we have this run lower. All of this displacement starts from this eye. So we have a range high here, and then we also have a range low down here from the previous day, which is Monday. So we have Monday's high there, or the high that starts the expansion cycle lower, and then we have the low here. Now, if you go out to the daily time frame and look at what daily premium or discount rest, you can see that we have a daily bearish block up here. So we have a daily bearish block up there. Then we have all of this fair value gap or imbalance down here. Now, if you go to the lower time frame, you have this small little range here, and I'm going to use the dashed line to delineate the liquidity. Now let's do the session, each of the session. Before we go back and go through the bulletin, we're going to do each of the session, right? Now what you see here is I started my anticipation, or I started looking for delivery utilizing the key higher time frame levels. And you can see the influence of those higher time frame levels on the intraday chart. You can also see that influence on the previous day, on Monday, which is the new week, which is this current week. Or you can see the delivery that ensued from there on Monday, and then today you can also see the delivery. So we're going to start with the central bank dealers range. Now this is the entire time window for the 3-day open to 3-day close. Asian range starts from 8 p.m. against all Eastern Standard Time. Between 8 p.m. to 12 a.m. is Asian range. So let's go and look for Asian range 8 p.m. to 12. So this is start of Asia to 12. And this is Asian, the Asian range here. And then we have our London kills on it, which is from 1 a.m. to 5 a.m. That's our London kill zone. So from 1 a.m. to 5. This is our London kill zone here. And then we're going to do the same thing for London launch. 5 a.m. to 7 a.m. is the time zone for London launch. I'm actually going to drop this on as part of the, or sorry, on the module itself, so you can always reference this. Okay, you can go and save the picture. I'm going to drop the actual .png file, and you can download the file. It's going to be like a few kilobytes, and then you can save the picture and actually use this for reference for your different time zone, especially if you're new to this. Okay, so this is your Asian session. I'm gonna make it a different color scheme so you see clearly what I'm talking about. This is Asian session. This is London session. And then what you have here is your London lunch, which is between 5 a.m. to 7 a.m. Eastern Standard Time. So between 5 a.m. to 7 a.m. that is your London lunch there. And then New York session is 7 a.m. to 9. That's your New York session. And between 7 a.m. to 9 is New York session. And then London close is 10 a.m. to noon. So we're going to look for 10 a.m. to noon. That is London close. And then New York close is 12 to 2. Until 2 is New York close. And then the central bank dealers range, which is a different topic. That's the next topic we're actually going to cover on the next video. That is 2 p.m. to 8 p.m. That is the central bank dealers range. So if you go back and look at 2 p.m. to here, that is the central bank dealers range. And your 3-day open starts from here, 12 a.m. midnight New York. That's your 3-day open. Sorry, London session actually starts from here. It's London session. Okay, so this is your 3-day open, and then 3-day close is the end of New York close. All right, so in between here is where we're looking to do the bulk of our transactions. Now you can see, like I mentioned, this day, which is yesterday, was a bearish day in price. So I'm going to use a different color scheme for London session. And then, oh no, it's a different color scheme for London session. And then for London lunch, we're going to go lower. Oh, come on. For London lunch, we're going to go lower. And for New York, again. And then for London close, and then for New York close, it's going to be this. Again, let's see, let's do this in here. Now, what you can see here is this is the key higher time frame level, and the key higher time frame level there is a daily bearish order block. So we're going to level this daily bearish OB. And I want you to see the displacement that occurs or starts with that daily bearish order block inside of the daily range. Now remember, if you remember the previous analogy or the previous example I used with the daily bullish candle, in the daily bullish candle, your opening price starts from midnight New York, not midnight GMT time zone. And what you're looking for in a bullish candle is you're looking for smart money to accumulate above the opening price at midnight New York. So now let's look for the opening price at midnight New York here. Okay, the opening price here for midnight New York is this. Instead, let's actually use a horizontal ray here. And that's the opening price for midnight New York. Okay, so this line here is the opening price for midnight New York. And what we're seeing is we're going to see the market, or we're going to see smart money accumulate shorts above the opening price. And then once we go below the opening price, we start to see the profit release phase as the market runs into an objective where there can be counterparty liquidity or offset reaccumulation. So you can see here, the central bank dealers range forms a little bit of a tight consolidation going into Asian session, and then once 3-day open starts going into London session, we start to see the initial jitter swing. Now, what's the jitter swing? Jitter swing is the manipulation during London session. The first phase of manipulation that induces retail against daily order flow. That's what we call the jitter swing, right? It's called the jitter swing because again, Judas betrayed Jesus. If you're familiar with the Bible or Christian lore, right? So that's why it's called the jitter swing. It's not my term. So if you're wondering, you can see the market runs above the short term high here. Now, at the point that this is happening, say we do it like this. At the point this is happening, don't you think everyone now is viewing this pair as bullish? They are. Why? Because we've seen expansion higher. And that's what this is engineered to do. Remember when I talked about engineering open flow liquidity? We have open flow liquidity on the sell side. So this run higher here is engineering open flow liquidity because people see this as clean lows down here, which is support. We're seeing the market test support during London session and starts to see a run higher and breaks a short-term high. It meets all the criteria for a bullish delivering price, right? But all this run higher was simply a run up into an high time frame discount, or sorry, premium. Remember, I talked about how liquidity will be provided intraday at these higher time frame levels, and you can see what I was talking about. So you can see the manipulation higher, which induces retail longs and creates more sales of liquidity down here, and then institutions go in and short above the short-term high. As the market runs above this major high here, and retail goes in long looking for breakout trading or buying, and you're buying all the retracement lower, the market then goes into, and look at what the market does during London launch, like I mentioned before. The classic cycle is 80% of the time, London makes the high, London launch goes into a consolidation that starts the first phase of the distribution or profit taken, or the market goes into a little bit of a pause for a New York session to start, and then during New York session you see a smaller jitter swing, right? Again, it's the same concept with the traded open, where you're looking for a false run higher at the open price, which is what we call market protraction. Okay, so the jitter swing for each session is what we call market protraction. Market protraction is the first run against our intended direction at the opening price, and this is typically the same logic I talked about with the data range, where if you're looking for bullishness on daily candle, most of the time you will see the market first run lower initially to allow for smart money accumulation and then start to run higher. And that's the same logic, or that's the same concept with each session within the daily range. If you're looking for weakness, right, you're expecting London to make the high, and then you're expecting New York to see continuation delivery, and then going into London close, the market caps the delivery for the day and sees a recovery back into the daily range, which is what you see here today. So during London session, the market runs higher, engineers or induces, sells our liquidity, goes up here, retail's induced to go long looking for buys, the market displays a little bit, goes in a little bit of a consolidation during London launch, and then going into the start of New York session, you can see the market protraction higher above a short-term high, right? So as the market breaks above the short-term high, retail is also looking at longs in the marketplace, and they're pairing their short positions against retail longs or buying the breakout here, right? And then where are they going for? They're going for the sales of liquidity that was engineered as we run higher during London session. So you can see during New York session, we continue the delivery cycle of London, where London did the bulk of the manipulation play, and then going into London close, which is this one here. You can see how we cap off the daily range, which is what I was talking about. This is the classic daily cycle where daily range is capped off during London close, New York City's continuation delivery from London session. London launch is where we don't even want to trade at all. So the sessions we're focusing on is during London session, New York session, and London close. That's what we're looking for. We're not interested in New York close. Okay, during London close, and then after after New York close, that's where your central bank dealer stream starts, which is this one, or what we call the dead period. So it's on here. That's the dead period where the market literally does nothing. Just know this is only for black swan events. If you see, the only time I've seen real expansion during this dead period is when there were black swan events, and that's where the market would expand like 400 pips overnight or like 500 pips overnight, and that can really be scary. And usually that will happen when there's like real world situations or like war or a global financial crisis, something like that. But it has to take a major event for that to actually happen. Or if a currency is being depegged from another currency, that's when situations like that happen. All right, so black swan events. If you go back and look at the time period where I think there was one on yen, 2017. Was it 2017 or 2020? I'm not sure. The black swan event on yen 2020. The black swan event on USD CHF 2014. The black swan event, I cannot remember the other ones. But if you go and look at the time period, usually it's during. Oh, there was also a black swan event on pound 2016. So if you go and look at them, you're gonna see that the time where they occurred was usually outside trade open or trade close, right? And trade open starts around 12 a.m. midnight New York and ends around New York close, which is 2 p.m., which is also the time where the commodity market or the futures market closes to, right? So again, you can go download all of this. I'm gonna drop the PDF on the. I'm gonna drop the file on the drive, so you can go download the file and look at the different time windows. And then going back to the bulletin, you want to trade in the direction of the anticipated daily range, which is our goal. Again, you're looking not to capture the absolute high. Again, you don't need to be shorting up here. Okay, you can wait for that displacement, then short during New York session, or return back up into premium, which is this bearish to the block, and short as the market runs up there, and you're aiming for sell side liquidity. And once the market gets down there, that's your trade, right? So it's gonna look something like this. The low of the candle of this bearish to the block is where your execution's at, and your sub goes above the bearish to the block, and you're aiming for the sell side there. And literally within 1, 2, 3, 4, within an hour, you get your trade and you're done. Again, you're not selling short at this side here. You're not taking profits at this level here. That's your goal. Your goal is not looking for to do this, to do all this. I call them Instagram entries. Probably for Instagram entries. That's not your goal. Your goal is to make money. That's your number one priority. Don't let Instagram fool you. Don't let Twitter fool you that you need to catch a sniper entry to make money. All you need to do is you need to know where price is going to. You need to understand how open flow liquidity is being engineered, and then just look for classic setup, and you're good to go. All right, that's what you're looking for. All right, so continuing from where we left off, your daily directional bias forms the bedrock of all day trade setups. And I've talked about this, and I've been hammering this for a while now. I think throughout the course, I've been hammering this concept that you need to have a clear understanding of what the daily time frame is doing, to have a full understanding of how the intraday profile was set up. All right, you need to understand where the key hour time frame levels are relative to current market price action. And then you also need to understand where the drawn liquidity is on the higher time frame, which will then give you an insight into where or how the manipulation play is occurring. Now, because we're bearish here, if you are bearish here anticipating bearish order flow, then you know that this run higher is not the true trend. You know it is simply a manipulation play for lower prices. But if you have no context of what the daily delivery should look like, you're looking at this run higher as the true expansion cycle or the true delivery, and you're going in looking for continuation longs higher, right? And then you take a trade and you end up getting chopped up by the marketplace, and now you're wondering, why did I take a loss? Because you had no context of what the daily order flow plus the key daily levels look like. And if you did not have that daily bearish block up here, this run higher does not really make sense to you, because you're wondering to yourself, well, if we're gonna run so, why did we not run this eye here? Because all the market needed to do was just to run the eye that started all this expansion cycle lower and go up into a premium array, and that was enough. But you're not aware of that. because you have no full understanding of your daily directional premise or daily directional bias. Okay, and going into the next point, which is the ideal scenario is day trading the weekly time frame direction. Again, it all goes back to number 5, which is your day trade should form from your daily directional bias, and that's what we'll call a high probability day trade. More time frame ideas help support your day trade, and your IPTA data ranges combined with the PD arrays are the foundation to day trades, which is your macro analysis. They create the foundation for the intraday template. Always. We're going to talk about intraday templates a few videos down the line, and you're going to look at the 6 intraday templates that might form so you can anticipate how price should deliver. But they are all based on how the daily order flow is delivering. Without the context of daily order flow, the templates itself are useless. Okay, your annotations intraday becomes less probability because you have no concept of what high time from price delivery is doing. Now, the only time you can go into the marketplace and trade both sides without an understanding or needing to know what the daily time frame is doing is when the market is in a consolidation, because usually when the market is in a consolidation, order flow is neutral. It's neither bullish nor bearish, so you can just trade lower time frame runs on liquidity as scalps, not even day trade. This is more of a scalp versus day trades. And then the last and final point is we stay flat during very volatile economic releases like FOMC or NFP or CPI, right? Or when there are multiple high impact releases during the kill zone. So if you identify a kill zone where there are, and this is my protocol, if I see more than 2 high impact economic releases for a specific session, I usually will wait until the last one if I'm looking for an execution, because there's a very strong probability there will be a ton of manipulation with the economic release. So now this is one you can see on Friday. This is London session, by the way. So during London session, we have a major impact release on pound. This is around 2 a.m. So 2 a.m. Eastern, we have a major impact release on pound. And then 3:15 a.m. Eastern, we have high impact release in euro. And then 3:30 a.m. Eastern, we have another high impact release in euro. And then at 4 a.m. Eastern, we have a major impact release in euro. And then at 4:30 a.m. Eastern, we have a high impact release on pound. So that's 1, 2, 3, 4, 5 economic releases in one session or one kill zone. So when I see this, I stay flat. I don't even go in and wait for the final news to engage. Right, I just stay flat until the next session, which is going to be in New York, and then I go in looking for an opportunity to trade. And that's a part of my protocol, because again, during economic releases are where you get high volatility in price, and if there are multiple of them per session, then there's a strong chance that a bunch of those economic releases could be a manipulation play. So you could have a bias, but the market spikes you up before going your direction, and you can't blame yourself because it was off the heels of a major economic release. I know there's always that temptation to want to go in and look for executions or setups during or around the time window where those economic releases form. But again, that significantly reduces the probability for the trading side in terms of your risk, because the market could go and spike you out, and you also run the chance of getting slipped, which is something your brokers can actually do to you. They can sleep you during high impact releases like this, especially if you're multiple. And this is something you want to avoid strictly, because getting slipped is the worst thing that could happen, because your 1% risk becomes like a 5% loss or a 6% loss, and that's not good for your equity curve. So you always want to avoid situations like this. Alright, so let's look at what frames the daily setups. What are the things or what are the tools or elements that we need to bring together to frame the daily setup? We need, number 1, high time frame institutional order flow. I've already hammered this already, so you know what this is by now. Number 2, we need IPTA seeking new levels in price for liquidity. Essentially what this is you're looking for the probability of one-sidedness on the daily time frame. I've talked about this in the short-term trading module. and you're looking for willingness to expand on the higher time frame. You don't want to see consolidation. You're looking for clear order flow, okay, with a clear objective, and that's what creates one-sidedness on the daily time frame. Number three, you're looking at your weekly chart current candle direction. Okay, so is the weekly chart poised to expand higher, or is it poised to see retracement? Because you could also have a bullish sentiment, and you could have an anticipation for bullishness on the weekly time frame, but that does not mean every weekly candle will see expansion. When are you going to see expansion? When we are at a discount relative to the weekly range, and we are in a condition that's predisposed for bullishness on the weekly time frame, then we're going to expect to see 2 to 3 weeks of bullishness, and we can go in anticipating some kind of expansion. But when we are at an higher time frame objective, or we trade up into a weekly premium, we can expect distribution. That does not mean a reversal. That only means just a retracement. And during weeks like that, we don't go in looking for strong buys intraday. Okay, we look for retracement or reversal setups intraday. Even though we understand that those reversal setups, they are only a play on a weekly retracement. Do you understand what I'm saying? Again, it's all about profiling the market and price fractal. A reversal on the daily range is not necessarily a reversal on the weekly range or candle. It's just going to be a retracement on the weekly candle. So you need to understand when your weekly chart current candle, or if your weekly chart current candle is poised for expansion in direction of order flow or not. Number four, you need to also anticipate day of the week. We talked about that on module 3, using your weekly template and anticipating the day during the week where you're more likely to see expansion. So go and study the weekly templates we talked about, and that will give you an insight into how to anticipate day of the week filter. And number 5, time of day. We're going to talk about this on the next few lessons. And finally, number 6, you're looking for a volatility expansion or large ranges using the previous day range profile and previous session range profile. So this is something I'm going to actually expand on. This is a new one here, which is using the context from the previous day to anticipate the delivery cycle for the current day you're trading, or using the context from the previous range of the previous session to anticipate the delivery cycle for the current session you're trading. And there's ways to go around that, so we're going to discuss all of that on the next video. And I'm going to wrap up this video here. I don't want it to be too long. It's almost getting to an hour, so we're going to stop here, and I will see you on lesson 4. Trade safe.